Good afternoon, folks. It's Dave Burrows, and I want to thank everybody for joining us for another weekly Barometer webcast. Here we are in the middle of June. Things have definitely quieted down. Volatility is certainly low, and market is not making a lot of progress over the last couple of weeks. But we thought we'd ask the question today, with some of the strength that we've seen over the last 7 or 8 days in secular growth stocks, is there a rotation taking place? Or is it a market broadening? And so we're going to touch on some sort of key themes today, talk a little bit about positioning, and take any questions, of course, at the end of the call. So just quickly, we always start with the structural backdrop. We believe we're in a structural bull market in equities that began in 2013 in the US when we took out the previous highs from the year 2000, much like when the market took out the highs in 1981 that we had made in 1966, 15 years earlier. And while there were lots of pullbacks along the way, notably, a crash in 87, a tough recession in 1990-91, it was sort of 4 steps forward and 1 step back. And that has been the case here in the US stock market over the last number of years. We've been making the case that we're going through a structural bottoming in yields, which takes some time. It generally isn't sort of a V bottom and takes off like a rocket. This bottoming process in the early 50s took 4 or 5 years, but it meant that the leadership in the market that came out after the turn in rates was quite different than the leadership going in. We've also been making a case that we've been going through a bottoming in the commodities complex, and that certainly has been playing out over the last 6 months and has been a key theme in the market. So just to touch from a high level on the major indices, this is the S&P. This is the corrective period we went through September, October, which really wasn't much of a correction at all. I think lots of people expected after the sort of straight up move off the bottom in March that there'd be a bigger correction than that. And we've been in this channel really ever since. And especially, when we look at it over the last few weeks, it's been a very slow, steady grind, extremely low volatility. And the market basically is sort of where it was about 5 weeks ago, although we did make new all-time highs this week. When we look at the NASDAQ had been lagging over the last few months and certainly played some catch up over the past 2 weeks. We had a little lift coming at the end of May, a little sideways, second lift coming early part of June. And again, NASDAQ has made new all-time highs. So that's important because there's some really important companies in that group. A lot of very large cap tech stocks have been used as a source of cash for investors who are rebalancing their portfolios, perhaps moving some money into some of the more value-oriented themes or more cyclical themes, things that are more economically sensitive. But as we talk about, things consolidate 2 ways. They go sideways in price, or they go down in price and take out some excesses. And this has been more of a sideways consolidation. So the question is, are growth stocks taking over from the value camp? And we'll look at that in a number of different ways. When we look at commodities, this breakout that we saw about 6 months ago sort of continues to slowly march higher. These are individual monthly bars. So that is moving forward, and that's a positive. When we look at the bond market, bonds have been selling off over the last year. We had quite a sharp move down in February and March, which actually scared the stock market a little bit because the stock market doesn't like to see a sharp rise in rates. It's okay with a slow, steady advance. And we really have consolidated in a range since March where the 10-year yield backed off about 20 basis points. Arguably, I would make the case that this is probably just a consolidation on the way lower in price or higher in yields. We have pretty steadily declining long-term moving averages. If we look at sort of overbought and oversold, after having a big move higher, the 10-year yield just consolidating here and pulling back, it's very quickly approaching oversold territory. That's yields. So interesting last week on the inflation data, despite quite a hot number, the bonds really didn't respond. So clearly the market is buying into the Fed's commentary around inflation being transitory. It bothers me somewhat that is such a consensus. We'll see how the numbers play out, but there are indications that some of the shortages in the supply chain are starting to moderate, and that maybe can help on that front. On the US dollar has been, again, consolidating over the last number of months, but still sitting along the bottom end of the range. Technically, we are in a downtrend until otherwise. The moving averages continue to work their way lower below the 50-day, 150-day, and 200-day moving averages. So that's US dollar versus the basket of world currencies. And of course, the Canadian dollar, we know, has been very strong. But weaker dollar assets have been leading since the beginning of November. So let's take a look at this week. Some of the stocks that had been lagging got a little bit of a bid. From last week's call, Tuesday, we highlighted that Amazon, after really getting compressed, had a good day last Tuesday, and that might be setting off the beginning of something. And here we are a week later. Amazon has been moving higher daily since last Tuesday. Obviously, very important, very big company, very big in a lot of the indices. And so that's certainly a positive for secular growth. When we look at Apple, similarly, Apple had a small move last Tuesday and has been working its way higher since. That's positive. That's an expansion of breadth in the market. And the question is whether that is going to come at the expense of other things. We know that generally in groups that have been under pressure, there will be leaders, and that the leaders, when the pressure comes off, tend really to accelerate away from their peers. And we know that semiconductors have been correcting over the last few weeks. NVIDIA certainly corrected with the group. But look at this last 3 weeks. So NVIDIA started to firm up well before large cap tech did. NVIDIA, of course, $440 billion market cap company, not a small one. You can see the relative price performance versus the S&P accelerating really from about the 4th week in May. And here we are, we've moved, kind of from $550 to $700 over a very short period of time. So that's the way a leader should act. It should lead the group, and then as the group is making a turn, accelerate away. And this is one of our key holdings in tech, although we are light in technology. So what do we see under the surface? So this is a bullish percent chart. It measures the percent of stocks within a universe that are performing well or are in clearly defined uptrends. In a healthy market, the percent of stocks in uptrends should be rising. And we know that since the end of May, 46% of all the companies in the NASDAQ were operating on buy signals or were in uptrends. And since then, that number has been expanding, and we've moved from 46% of stocks in uptrends to 58% of stocks. So that's a healthy thing, because that had really been weakening since early February. So that means this group certainly is seeing a bid. The question is it coming at the expense of any other groups? So why don't we talk about that a little bit? When I talk about breadth, the concept is that in a market that's declining, eventually some of the stronger stocks will turn higher first, and then the buying will start to spread. And as you go through a rising market, a higher and higher percentage of stocks should participate in a rally. That's a healthy market. The buying is spreading out. Eventually, though, breadth will start to narrow. So when you get concerned about a group that might be running out of steam, it's not going to be the leading stocks within the group that give you the tell. You want to know what the weaklings are doing under the surface. So if I were looking at my portfolio and said I wanted to reduce my exposure, say, to industrials, I would be looking probably at my weakest positions to sell. So that's the way it is across the market. Generally, the weakest stocks will roll over first. And then if it continues, it'll get to the stronger and stronger companies, and pretty soon you're headed lower. So the question is that happening in any of the leadership teams? Well, when we take the NYSE, which is largely more focused on sort of the value parts of the market, NYSE bullish percent is sitting at 72%. So that's where we were just a snip below that last week. And as you can see, as of this morning, 71.7%, meaning that despite the fact that the NASDAQ is showing expanding breadth, we are not seeing deteriorating breadth in the NYSE. In other words, the strength in NASDAQ is additive to what we are seeing across the market. So when we take all stocks in the US, NASDAQ and NYSE, and of course Amex as well, again, we're seeing expanding breadth. So now 62% of stocks across all US exchanges are in uptrends, and that's the best level we've seen since late February. So more of a broadening than a rotation. We can look at it a couple of other ways, but the upshot is that our key indicators, breadth, big picture breadth indicator for all US stocks, expanded again this week, got a little better this week for all world stocks. And we can see that the short-term indicators for the most part are green. And most importantly, the percentage stocks with positive weekly price momentum or upward trajectory firmed up this week, especially in the NASDAQ. And that's, again, a healthy thing. So both the short and long-term indicators continue to stay internally the market on a good footing. Credit markets showing that credit spreads continue to be benign. So in other words, bond investors are not demanding higher yields to take credit risk in a corporation. In fact, they're about as low as they've ever been. So that's very healthy. No concern in the bond market. Volatility spiked, of course, last spring. It's had a number of little bounces since then, but we're back firmly in normalized territory. So no major expectation for a pickup in volatility, despite the fact that very often in May and June, you can get that. And when we look at the breadth readings for markets around the world, you can see that again this week, more green on the screen than there is pink, meaning these markets in green are all showing expanding breadth. Now, you will note that in particular, global markets, developed and emerging markets are showing expanding breadth. And that's important because that has to do with the synchronized global reacceleration that's taking place. And if it were just sort of the US that were leading and it was just growth stocks leading, that would just simply mean, the money's got to go somewhere, but we're seeing buying spread really around the world. When we look at our sector breadth models, you can see this week software breadth turned positive. So all of these sectors in large caps are seeing expanding breadth. Some have stronger relative performance than others. So the green ones are the strongest, but software improving this week, retail improving this week, financials improving this week, media improving this week. And you can see almost all of the major sectors are showing expanding breadth. Again, that's very healthy. So let's just examine some of these themes. Software over the last 3 weeks, accelerating back towards highs. That's a positive. Healthcare, after really lagging for a few weeks, accelerates back to new highs led by biotech. Biotech, in fact, last week had one of the strongest days on record. Energy, which we've been talking about for some time as being an important part of the Canadian market, and a group that is a real potential beneficiary in a reopening, continued to firm up this week. But when we look at it, the leading stocks outperforming the index. So there is energy back to 2014. And yes, it's broken the downtrend. When we look at the highest quality companies, they should be performing better. Canadian Natural Resources virtually back to the levels it was at back in 2014, a long way ahead of what's happening for the energy index itself. So, our work is all aimed at trying to do two things. From a top-down perspective or a macro perspective, our job is to identify the asset classes and sectors and geographic regions that are showing expanding breadth and focus in those areas. And we run those models daily looking for change. As I've just shown you this week, there's a larger number of sectors and a larger number of global markets that are showing expanding breadth. So it means the market is strengthening internally. So then we take those groups that are showing us expanding breadth and we try to find investment targets that are performing better than their peers. And when I say that, I mean fundamentally, when we look at certain readings on income statements and balance sheets, they're showing us acceleration or improvement in very important metrics, especially relative to their peers. It's very quantitatively driven. And then we also want to find that the prices of these securities are outperforming their peers, because it means that we're not the only ones that believe it. And then, of course, we've got a deep dive to do fundamental research on the individual businesses. But 80% of return is get the market right, get the sector right, and then follow up with the companies that have some improving ability to pay a dividend or a distribution, or improving ability to grow based on products in the marketplace. So let's talk about leadership. Going back to financials, which we've talked about for quite some time, they consolidated over the last 2 weeks. And despite the fact that we've seen strength in growth stocks, today had quite a good day. This is the insurance ETF KIE. After consolidating, we're breaking out to the upside. That's very positive. This is the investment dealers and capital markets ETF. So these are more market related companies. And again, looking for those companies that can outperform. A great example of that would be Blackstone Group. Blackstone Group, a major holding for Barometer, a $66 billion company that's in the alternative asset management business. They've done a great job of growing their earnings and cash flow, and the earnings estimates are working their way higher. Good, strong earnings growth going forward, and strong relative price performance versus the market, making a new relative strength high today, still only trading at 17 times earnings. Royal Bank, another great example, and CIBC, all three consolidated a little bit, now moving higher, sort of ahead of their groups. Energy, we talked a bit about energy, and we talked a little bit about CNQ as being a leader. But certainly, to put a point on it, if we were to go back to the bear market that ended in 2015 and take $100 and put them in both the energy index in Canada or CNQ, the energy index $100 is $90. The $100 in CNQ is $180. That's a leader in the group. So when the group takes off, look what happens to the leading stocks. So you can be a passive investor and just buy ETFs or just buy the broad market. We think you're a lot better off trying to identify the key structural themes and then either focus in that specific theme with an ETF, or more importantly, in an equity pool or our income pool, rifle shot ideas that have an opportunity to really significantly outperform the group. Then you're taking advantage of all three things: asset class, equities; sector, energy; and geographic region. Other groups that have been leading, maybe consolidating a little bit, was the industrials group, pulled back from the moving average, accelerated a little today. We'll see whether we get some follow through there. But when we look across our groups back to the beginning of November, when the value leadership theme took off, here is the S&P. NASDAQ slightly leading, but we can see narrowed over the last couple of weeks, narrowed the lead. The groups that have been lagging continue to lag. That's XLU, that's the utilities or the bond proxies. That's the long-term bond, TLT. But out ahead of the S&P are industrials, European stocks, dividend growth, large banks, small cap value, been consolidating over the last couple of weeks, miners, and energy. All of these will have consolidations along the way, but we're looking for breadth, and the breadth in all of these groups continues to expand. So outside of the US, things that are more value oriented, things that are more sensitive to global growth. This is the PIE, which is the Emerging Markets Momentum ETF. Again, a couple of weeks of consolidation, breaking out to the upside today. It looks like that's about to retake the lead. We have European stocks, which continue to march their way higher based on the fact that they do have such significant exposure to industrials and financials. So this is since the beginning of November. European stocks outperforming the S&P. So how does that help us to know that we're seeing broadening, not rotating in the market? Well, when we look at the rest of the world versus the S&P, The rest of the world has far less technology than the US market, but far more financials and industrials. Our focus, as you know, right now, much greater weight in financials and industrials and also energy. But that's why the European equities ETF is outperforming the S&P. It's sector makeup. So it's great to see tech lifting, but it also, we can see by the European stock performance that there's still good, strong strength in financials and industrials. So look, our job is to do three things. It is to identify and focus in areas of market leadership without a bias. As markets broaden, we want to make sure that we take advantage of all of the opportunities. So if we have a sector broadening, we will take from a strong group and add a little bit in a group that has started to participate in the rally. We're always watching for change. And then in the absence of leadership, have an ability to either exit a big group or go to the sidelines overall in equities if we're seeing risks elevated and deteriorating breadth there. None of that is the case right now. We're seeing expanding breadth globally. We're seeing expanding breadth sector to sector. We are trying to take advantage of each of the various areas of leadership in the market. We're trying to stay tactical. So from an exposure standpoint, we're going to keep this sort of tight today. We've taken down our financials exposure a small amount, not because we think there's a problem, but because tech is improving. So we bumped up our tech exposure. We also have bumped up our energy exposure because the energy continues to make ground and continues to solidify this early stage, potentially new secular bull market. Materials we took down very slightly, industrials we took down very slightly, and the rest of the groups continue to be quite small. So remaining quite focused in economically sensitive sectors, remaining quite focused in more value sort of camps. In our global macro exposure, again, is very similar to the themes that we've been talking about: precious metals, financials, energy, commodities. The difference here is significant exposure to emerging markets and developed markets, Asia, developed markets, Europe, and some global small companies, short utilities, short US dollar, and short the bond market, with a view that interest rates are headed higher. So we watch every day for signs of weakness and narrowing. We'll be very quick to take action should that be necessary. But as it is right now, it seems to be steady as she goes. And very soon we'll be into that seasonal period in July when we tend to have a good summer rally. And after the fact that we've seen lots of sectors just pause and take a breath, it's very possible we could see a good summer acceleration. So with that, I'm going to take a look and see what questions we may have, and see if we can answer. So I have a question on lumber. I'm going to stop sharing this just for a moment. Okay, so this is a chart of Interfor, a large Canadian lumber company. Certainly, it pulled back over the last few weeks from the beginning of May through into the middle part of June. We had a nice reversal. Consolidation looks like we're trying to move higher here. I think we're probably done. There's a lot of the commodity stocks have pulled back into the longer term moving averages. And so I think that they're probably okay. Certainly continue to see, higher highs and higher lows. And so we don't have a lot of exposure here, but we have some, and we would look to add on any kind of reacceleration. What other questions do we have? Oh, one of the questions we have here is, why is the global macro pool invested mostly in ETFs as opposed to the companies? And the answer for that is that, as I said, 80% of return is getting to the right neighborhood. And on US stocks, very easy to identify specific companies, but macro reflects the fact that this is a fund that's aimed at focusing on the themes themselves, not trying to get too granular with individual positions. Now, the reason for that is, let's say emerging markets are performing well. It's very difficult to take a really rifle shot approach with emerging market equities when we can go out and take a look at, the PIE, which is the emerging markets ETF. If we're looking at Taiwan, which we own, again, very difficult other than just going to buy Taiwan semi. If we're looking at certain commodities, again, better the commodities companies can often have a more binary outcome, and so like to have a basket approach. But from the beginning, the Global Macro Fund was aimed at focusing on macro themes and taking business risk out, the risk of a black swan event in a specific company, and really just focus a little bit more on themes. It's a long short portfolio that can be short major themes, so short bonds or short the US dollar, or short bond proxies through the XLU, which is the utilities ETF. But it's the only one of our pools that is focused exclusively using ETFs. And there's also quite an interest in the broad range of ETFs that are available out there. So we use them to express our views. Next question. There's a question here on the Fed and what we believe the Fed might message tomorrow and the expected impact on cyclical and technology trades. So it's a good question. So we've had some hot inflation data. Certainly the market has been shrugging it off. And I think it's because the Fed has been so clear in its messaging that they plan to keep rates sort of in check, and that they don't plan to raise the Fed funds rate anytime soon. I'm going to watch the market for the cue before I listen to the Fed, but likely the Fed will continue to message that at some point they may start to taper their bond purchases. But my guess is that they're going to continue with the same messaging, which is we believe that inflation is transitory. And so my guess is that you're going to see probably tech continue to do okay in that case. But certainly the cyclicals can perform well also, because of course the concern would be if you were to ratchet rates too high too quickly, that could choke off economic growth. And I think we're sort of in a Goldilocks environment right now where we got low rates and a strengthening economy. See if there's any other questions here. But the 10-year yield going lower, are we still bullish the US banks with that divergence taking place? And I guess my comment would be that when we go back and look at yields, and not sure I can put it back on the screen right away. The move lower in yields, I don't think is doing anything to change the longer term trend. So like in commodities, we're going to move higher, we're going to pull back, we're going to move higher, we're going to pull back, move higher, pull back, move higher, pull back. So I think so far this little pause in rates is not something that's significant. And I think it looks like the bond market tells us the stock market tells us it believes it, because after the banks consolidated here, we're reaccelerating to the upside. Same thing with the insurance stocks. So I tend to believe the market more than commentary, and so until we see some real damage, technical damage in the financials, my guess is that this is just a pause in rates. And I think that's it. There's one question here with a number of individual stocks, so I might just address that one directly. And if there's not any other questions, we might be done for today. I want to thank everybody for joining us. It's become a great habit each week to do these webcasts. If you've got things that you'd like us to discuss next week or any week coming up, please don't hesitate to reach out to us. The reason we're doing these is to try and give people a clear view as to how we make our decisions, what drives it. It's not opinion, it's process. And hopefully it gives people some confidence that we're trying to do things in a repeatable way. So until next week, thanks very much for joining us. And we look forward to seeing you again next week. Have a great week.